Now, fair value gaps can bring you a lot of profit, but you need to understand that not every fair value gap is the same. You have good fair value gaps and bad fair value gaps. And that's exactly what we are going to go over. In the 6th video of the MMC series, we're going to touch on fair value gaps and the different fair value gaps that we also have. In the first slide, I want to revisit the previous video that we had about narrative, where we touched on the first line of defense. So the first PD rate that we run into when we create a retracement is ideally the fair value gap that we have sitting right there. This is focusing on that we already have the direction, that we are now looking at a fair value gap to trade from. And we know, based on the previous video as well, that ideally we want to see the float being a fair value gap. But within that, we still have different types of fair value gaps. So moving on, we start off with a target. If we want to understand if we are trading from a good fair value gap, then we first of all need to understand what the target is. So what do I mean by that? The target is going to be on the left side and we trade from the right. What do I mean by that? Well, if we take a look at this example right here, then we see we have a target on the left side. That target is not within the current order flow lag that we are trading. And if we are looking to trade towards that target, we are going to use a fair value gap sitting right there on the right side in the most recent price action. So we're always talking about the most recent order flow lag and the most recent fair value gaps as well. So to show you an example here on Canadian dollar JPY on the daily time frame, we have this fair value gap right there that we are looking to trade from, and we have a target towards the left right there in the form of those swing points and those fair value gaps that we talked about in earlier videos. That is towards the left because that is going to be our target. So whenever I refer to the right side of the chart, I always refer to the most recent order flow lag. All right, so once we have that target on our chart, we also need to understand where do fair value gaps actually get created. Fair value gaps get created at unmitigated opposing PD arrays. Now, what does that mean? Here in this example, we have a lot of candles. And at the top right there, we have that swing high. Let's say the previous price action was pointing, so we had bullish price action, and we could argue that we want to trade into that swing high right there. So that is our main target. On the way to that target, we will encounter unmitigated opposing PD arrays. What is that? First of all, unmitigated stands for it has not been traded into before. So for example, on Canadian dollar JPY, this fair value gap is now mitigated. It is not unmitigated anymore because we have traded into it right there. But this fair value gap, for example, is unmitigated since there was no price action, there was no trading inside that fair value gap. But this fair value gap, for example, is unmitigated because after the fair value gap was created, we did not trade back into it just yet. This can also be said about swing highs or swing lows. So for example, this swing high has been traded back above. Now it's mitigated. But this swing high right here is unmitigated. This is extremely important to understand. Otherwise, you're going to lose a lot of accuracy and we're not going to be on the same page anymore. So for example, this fair value gap right here is unmitigated as we continue higher. But as soon as we come down and with that first candle right there, the smallest price movements inside this fair value gap that has been created, now it is mitigated. So we don't use it anymore. Now that's the unmitigated part. Then we move on to opposing PD arrays. What are opposing PD arrays? Well, if we continue higher and we are bullish, discount arrays are going to be holding. We have discount arrays as order flow lags. So if the trend is bullish and discount arrays are holding, that means premium arrays are the opposing PD arrays. So in this example, we have this fair value gap sitting right there, which is an unmitigated opposing PD array if we want to continue higher, also known as resistance. This fair value gap is going to resist us from reaching that target right there. So when we trade back into that right there, since it is resistance, we can expect some kind of rejection. Now, whether the rejection is very big or very small, that's what determines what type of fair value gap it's going to be. But at those unmitigated opposing PD arrays, that's where we create new fair value gaps. Now we have another unmitigated opposing PD ray, and that is this swing high sitting right there. So when we trade into that, that is exactly where we can expect a rejection. That resistance area creates a rejection, and that rejection creates a new fair value gap right there that we can continue higher off of. So if we again take a look at Canadian dollar JPY, we have this as our main target, this intermediate term low. On the way there, we will see that we have a few unmitigated opposing PD rays in the form of this swing low, for example. When we continue lower, create this expansion phase candle, the second candle of the fair value gap, the third candle stings into that, the fair value gap gets created at that unmitigated opposing PD ray. That resistance area then causes a rejection, and that causes the retracement to sting back into the fair value gap to then continue lower. Now that's quite a lot going on. We're going to break that down fully so you can easily understand it. So the important part is to understand unmitigated opposing PD rays, that they act as resistance for price action. When we run into that resistance, that can create a rejection, which can create a fair value gap to then continue higher or continue lower. That is where fair value gaps get created. Now first, we need to understand the basics of a fair value gap. A fair value gap is a sign of strength and intention. When I mention strength or intention, I mean the same exact thing. There are bigger entities trading the markets that we also trade, with a lot of money on the line. They can move the market. So when they move the market, they can't simply hide that. And what happens when they move the market? They create fair value gaps. So they show the intention of what price actually wants to do. They show the strength. Now there's three options, and each three show different types of strength. First of all, what we're seeing on the left right here is two candles. So we need one more candle. The first candle of any fair value gap can either be a down candle, an up candle, consolidation, doesn't really matter. The second candle, if we are talking about a bullish fair value gap, is an expansion phase candle. An expansion phase candle means that it closes above the previous candle high right there. So above the first candle high. And since it closes above the first candle high, it creates the future potential fair value gap in the form of this area right here. So this whole gray box is where we can potentially see a fair value gap. Then the second candle, that candle is called the expansion phase candle. And now depending on what the third candle will do, that will determine what type of fair value gap we have, a good fair value gap or a bad fair value gap. The first option is the following, a rejection third candle. Now, what does a rejection third candle looks like? Well, first of all, where does a fair value gap again potentially get created? That unmitigated opposing PD ray right there, like we're seeing in the example. Now, that unmitigated opposing PD ray is also a previous target, of course, because we're always moving towards those PD rays. So once we reach that target, we want to be a little bit more careful and see what we want to do right there. Because the third candle of this new fair value gap that could be created could be a rejection third candle, like we're seeing right here. Now, why is this a rejection third candle? Because we saw how big the fair value gap could potentially be with the gray box that we just saw. Now we take away all that potential fair value gap and we create a large down candle actually rejecting lower. Now, what is the thought process behind this? Well, if we want to continue higher right here, then we should have quite a lot of bullish strength, right? And if that fair value gap was supposed to be quite big, but all of a sudden now turns into a very small fair value gap, that tells us that there's also quite a lot of bearish strength in the market. And this is not good. Now we'll go more in depth on this later on. Then the second type of fair value gap that we can have is the consolidation third candle, where the third candle is a consolidation right there. This is the perfect fair value gap. Then the third type of fair value gap that we can have is an expansion third candle. So when we were talking about the second candle of a fair value gap always being an expansion phase, that same exact thing happens, but now on the third candle again. These three options show different types of strength, where this one shows a lot of bullish strength. The consolidation shows still a lot of bullish strength because we have created a fair value gap, but just enough bearish strength to create a consolidation and to create a retracement. The rejection third candle shows too much strength to the opposing side. And of course, when we are looking for bullish prices, we don't want the bearish side to be extremely strong because that can lead to either consolidation or can lead to lower prices, which of course, if we want higher prices, not something we want to see. So let's dive into these different third candles right there, these different type of fair value gaps. Where the first one is again the rejection third candle. Now, just for simplicity's sake and just so we know what we're talking about, I've named it an RFVG, rejection fair value gap. Now, when we see this three candle pattern, we want to, of course, go over, have we ran into one of those unmitigated opposing PD rays? Because if we did, then we can also see that we are actually respecting that opposing PD ray, which tells us that there is some bearish strength in the market. Now, this is the worst FVG to trade from. Shows too much bearish strength. And of course, we can just simply inverse it if we're talking about a bearish fair value gap and there's too much bullish strength. Like we mentioned, usually comes from an unmitigated opposing PD ray. When we have an RFVG like this, we want to make sure that we require more confirmation. So for example, if this is a daily fair value gap and we want to go into the 15-minute time frame eventually for our entry confirmation, then we want more confirmation than usual. Because this is a sign that we might just actually continue lower instead of continuing higher, even though there's a fair value gap right there. Because something like this might just happen, where we actually create a new down candle and we just simply continue lower, disrespecting the bullish fair value gap. Now, there's a lot of beautiful examples right here on the gold chart. Then if we pay attention to those unmitigated opposing PD rays, here we have this swing high right there. This is something, when you start paying attention to it, it will happen extremely often. When we reach a high like that, and we are respecting that high right there based on candle science, that means that we are potentially sweeping that high because we are wicking it. When we have a sweep like this, coming back into a fair value gap right there, that is not the ideal scenario. That makes this daily fair value gap already lower probability to trade from. Because when we have a sweep like that, we can actually look to continue lower instead. So the bullish fair value gap doesn't have a lot of significance anymore. It has more significance before we reach that high. So since we are respecting that high, we can expect a lot of bearish strength in the market as well. So as a general rule of thumb, fair value gaps that are being traded back into when coming off a sweep like this, those are not good fair value gaps. They can hold, but you would want to see more confirmation because the retracement into the fair value gap tends to be a little bit deeper than normal. Now, if we then continue lower, and we understand that this is also a bigger fair value area, right? So if we're not offering fair value anymore, we could potentially be seeking liquidity. So these lows right here, the low of this bigger fair value area, could be the target. On the way towards that low, we will see that we have this fair value gap right here, which also creates this fair value gap that we sting back into. Now here, we don't have a big rejection higher, I would argue. But if we take a look at this scenario, where we have this fair value gap sitting right here, look at the difference in the rejection from this fair value gap back to this fair value gap, and from this fair value gap back to this fair value gap right here. We could have created a full fair value gap like this right here, this big, but only about, what is it? Not even 25% of the potential fair value gap is actually created right there, creating an extremely big rejection higher. Since the rejection is so big, there's a lot of bullish strength in the market as well. So we can actually expect a deeper retracement or even higher prices. This is not a good fair value gap to trade off of right there. And if we do want to continue lower, we would want to see more confirmation. Now, what more confirmation is something that we'll dive deeper into when we get to entry confirmations. These FVGs is the ones we want to watch out for, where the rejection is very big, because these are the worst fair value gaps to trade from. Now, moving on to a better fair value gap is the consolidation third candle. I just labeled this one as the PFVG, the perfect fair value gap. It all starts again with that PD rate that we have towards the left right there. Now, we could argue we are still respecting that because we are wicking it, but the rejection in the third candle right there is not as big to continue lower. This means the following. This is the best FVG to trade from. It shows little to no bearish strength. And of course, if we inverse it again, shows little to no bullish strength. When we have a fair value gap like this means that we have a perfect fair value gap. We see that the potential of the fair value gap was large, the expansion phase candle, that second candle. And also it created a very big fair value gap. This shows that in that third candle, there was enough bearish strength to create a retracement into the fair value gap, like we see right there, but not enough bearish strength to create a full rejection. So if it helps, we could put this into a percentage. Here we could argue we are 80% with the bullish strength, 20% with the bearish strength, where we still create a retracement, enough of a retracement to sting into the fair value gap to then continue higher. Whereas with the rejection fair value gap, we are more like 60% bullish and maybe 40% bearish. And that's why we create such a big rejection. Now, the closer the bullish and the bearish percentages are to each other, so if they are 50-50, that of course means that we have a consolidation. So we want to find the perfect balance in that. So on Canadian dollar JPY, we see right here, we have this as our main target like we already discussed. The fair value gap gets created based off a rejection that we have right here at that swing low. We could make the argument that this is somewhat of a big rejection. So if we go down timeframes into the 4-hour time frame, then we could wait for another fair value gap to continue lower instead, more confirmation. Now what do we see right here? We get this fair value gap right there. Does not necessarily get created at the opposing PD rates right there, but we have a perfect third candle consolidation right there, which means we can sting into it to then simply continue lower. But if we now confirm this again into the 1 hour, then we see off of the 4-hour fair value gap, we also create this 1 hour fair value gap right there at a previous unmitigated opposing PD ray, which causes the retracement, the third candle being a consolidation, which we can then perfectly fine continue lower from. These fair value gaps are the perfect fair value gaps, hence the name PFVG. Now, after the PFVG, we have one more type of fair value gap, which we have to understand because these are also very common. And that is the expansion third candle, also known as a breakaway gap, the back right there. Now, with the breakaway gap right here, there's a difference with the previous two examples that we have for the perfect fair value gap and the rejection fair value gap on where we want that opposing unmitigated PD rate to be. Because here, ideally, we don't want to see that we have reached that target just yet. Now we'll dive into why. This is not the worst and not the best fair value gap to trade from. It shows a lot of bullish strength. So if we're talking about that strength, this could be 100% bullish strength. But is 100% bullish strength always what we want? We could argue, and logically speaking, yes, of course, we want that. But when there's too much strength on one side and we actually don't create a retracement, then it makes it more difficult for entry and for the risk management. So yes, it's good to still trade off of it, but it makes it a little bit more difficult because now you deal with a lot of different variables as well. How far can we retrace? What is a good fair value gap on the lower time frame? Where can we place our stop loss? There's a lot more going into it. Whereas in the perfect fair value gap is a lot easier, a lot simpler to trade off of. Now, when we talk about this breakaway gap, we want to do the following. We want to make sure that we only trade it if the unmitigated opposing PD ray has not been reached just yet. Why is that? Because then it still has room to continue higher. Whereas if we reach that PD ray right there, then like we saw with the perfect fair value gap or the rejection fair value gap, we can create a bigger rejection. We can create that fair value gap to then continue higher. So we can actually expect price to reject a little bit. But if we have not reached a PD rate just yet, we can expect price to still continue higher a little bit before we create any rejection. Now, we can capitalize on it through the following. We can go down time frames and find a new fair value gap to capitalize on the understanding that the next candle will most likely reach that PD ray. Very similar to what we went over in candle signs. We understand the next candle is most likely going to be a bullish candle until we reach that PD ray. So if on one time frame that's a singular candle, we can go down time frames to find the order flow lag that will take us there. And then essentially it's the same thought process, because then again we look, is it a rejection fair value gap, is it a perfect fair value gap, or a breakaway gap? Now this will look something like the following, where the next candle is just a bullish up candle right there, continuing the trend. Now, if we take a look at US dollar, Canadian dollar on the daily time frame, here we see that we have this as our main target, the highest swing point. Then, before we reach that, we actually have this swing point and this swing point as well that will act as that resistance, those unmitigated PD rays. Now, the important part that we see as well, if we compare it to those perfect fair value gaps and also those rejection fair value gaps, we do not create a rejection of those previous resistance areas. Now, with that understanding and understanding that we can still continue higher towards this swing high right there, whilst not creating a rejection, that indicates that these right here are actually breakaway gaps, where most likely we can already deliver higher towards the target that we have right there before we create a bigger retracement. So if we go down time frames and we look at this area before we reach the highest swing point right there, then we will see on the 1 hour right here, we run into this resistance area. This resistance area actually gives quite a big rejection, I would argue, on the 1 hour. But afterwards, it creates a new fair value gap right here, a new order flow lag to continue higher from. And this is then a fair value gap that we can again simply trade off of to then continue higher. And afterwards, we create even new fair value gaps right there and a small fair value gap sitting right there, which we can look to continue higher from to eventually reach the main target that we had right there. That is how we can capitalize on a breakaway gap. Now, capitalizing on breakaway gaps is a little bit more difficult, requires, in my opinion, a little bit more experience as well. So if you're just starting out and focusing on fair value gaps, then just focus on the perfect fair value gap, because this again is the best FVG to trade from. And I want to emphasize on the fact on any given time frame. So from the 1 minute to the yearly time frame, it does not matter. This is the easiest fair value gap to capitalize on, especially when you're just starting out. Breakaway gaps are just a little bit more difficult. So first, gather experience with fair value gaps, then eventually you can look into breakaway gaps as well. The rejection fair value gaps that we have, you can simply avoid them. So only focusing right now on these perfect fair value gaps as our first line of defense. This is then what we can trade from eventually and where we can use our entry confirmation. Now, I highly recommend doing a case study because you'll never truly understand concepts if you don't do a case study. So the case study for this video is study which fair value gaps hold and which ones don't, and then label them. So what I mean by that, go into any instrument, let's say the dollar right here. Go into any time frame. So let's pick the 15-minute. Simply mark out all the fair value gaps that we had in recent price action right there. Then see off of which fair value gaps we actually followed through. Meaning we actually continued lower and created new fair value gaps right there. See where they get created as well. And then start labeling them. So is it a rejection fair value gap? Is it a perfect fair value gap? Or is it a breakaway gap? You can again use the study notion that I made completely for free. It's in the link in the description. All right, perfect. Thank you.